talking into a computer over the last couple of years. For those of you who don't know, Mark Gingrich, he's a partner out of our Columbia office on the tax side of the shop. I say this, probably one of the best people I know about taking a lot of these tax law changes, disseminating them in ways to create business solutions and help kind of create planning opportunities with them. I'm Jeremy Morris. I think I know most of you in the room, if not all. Tax partner in our Jefferson City office. Work with Mark a lot in the kind of the leading up the group of individuals that look into our tax law changes, and again how to hopefully help for planning opportunities with our business clients. So we're really happy to have all of you here today. We're going to go. We hopefully will finish a little early. Have time for questions. If you guys have any questions throughout, this is one of those presentations we expect to get a lot of questions similar to, hey, hypothetically speaking, I have a friend who owns a business, and what do you think about this? We would be happy to answer those questions, and we'll definitely stick around afterwards if anyone has any questions as well. So the first thing is we said, well, okay, how did you get to this point? And if you know this credit, even though we hear a lot about it, Mark and I were joking that we needed to bring in a lot of the, hey, get rich quick sort of commercials you're hearing about all of these tax credits. In some ways, it sounds like this is a new credit, but really this thing's been around, for 2.5 years now. This came in with the CARES Act at the same time PPP did. We didn't pay a lot of attention. Again, these dates aren't necessarily important, maybe with the exception of that December 2020 date, whenever they opened this program up to people that had PPP loans. Because previously it was an either-or situation, and now it's a both and at that point. So we've been talking about that. It's existed for 2.5 years. We've been talking about it for at least 1.5 years. We helped lead an online presentation in March of 2021, helping businesses, given the notices and the guidance we had at that point, try to help them self-select into the program within the framework of how you qualify for it. So given that fact, I guess the question that everyone may be asking themselves is, why are we still talking about this credit at this point? 1.5 years in, again, been working with clients all throughout, and I think there's a few reasons for that. One, if you think about when our last presentation on this was, and you think about when it opened up, we were still in COVID times, so to speak, in that time. Businesses were still trying to figure out what the impact was on their operations, trying to get back to normal. You added that labor market shortages, labor shortages within the market. And other, PPP loan forgiveness, at that point, people were still focused on that. I think it wasn't necessarily top of mind for a lot of businesses at that point. The other thing you can see from this chart is that this thing has changed, both in how it's calculated, requirements for it, as well as periods of time even that you're eligible for it. So anytime you have change like that, it's going to breed confusion associated with it. And so I think that's why it's still a bit of a new issue for folks, because it's continued to change throughout. Finally, and maybe one of the larger reasons now is that as this credit is matured, for lack of a better word, as more people become aware of it, there are also more players in the market, so to speak, related to this, other advisors who are coming in and, frankly, in some situations, making really aggressive claims related to this credit, collecting very aggressive contingent fees associated with the credit. And a lot of that information is, kind of being thrown around. Mark and I refer to that as the country club sort of conversations that are happening related to this. And there's a lot of noise in the market related to who can qualify, who doesn't, and how this credit's calculated. So that's really what we want to focus on today, is kind of cut through some of that noise. So in the last 1.5 years, take the experiences we have had in talking with our clients about this credit to help, your businesses or clients customers that you work with, help them navigate the credit, dispel some of those myths. Again, there are some things that it's going to be a gray area in a lot of this, but we are getting better about, even if we don't exactly know what will qualify in all circumstances, I think we're doing a better job, have enough guidance to know in a lot of situations what doesn't work, and then make sure for those that maybe just this hasn't been front of mind to, for businesses that actually qualify for the credit, how can we make sure you get the credit that you deserve and are entitled to under this law? So that's the agenda for the day. With that, I'll turn it over to Mark. He's going to give us a breakdown of the credit in 2020, 2021 to kind of give us a broad overview and context for the remaining discussions that'll occur.
Yeah, and I apologize to anyone who's already listened to some of our early presentations and feels like they have this nailed, but I think it is helpful if we kind of just level set, make sure everyone's jumping off from the same point. So we have a grid here in your materials. Don't try to memorize it right now, but there's basically 2.5 requirements to get into the ERC. So what I call the half requirement is you have to have wages, right? If you figured out how to build a business with no humans, this credit's not for you because this is a payroll credit for payment of wages. So then once you clear the hurdle of, yes, we've paid people to do work for us, then we're going to have 2 different pathways, and we're going to spend a lot of today talking about these 2 different pathways. So those are number 1 and 2 on the left-hand side. The first pathway to get access to the credit, and we've intentionally numbered them in this way, as you'll see in a moment, is a significant reduction in quarterly gross receipts revenue. If we don't fit through that door for all the periods that we want to fit through that door, then we're going to look at whether a government order caused our business to shut down in whole or part. And if it did, then we're going to get access to the credit that way. Now, of course, because this thing has changed so many times over the last 2.5 years, we have different thresholds for qualifying in the year 2020 than we do in 2021. So in 2020, we're going to see that it's a $5,000 per employee max credit. And in 2021, it's going to become a $21,000 per employee max credit. So when you listen to the radio and they talk about this program, you hear them say, get $26,000 per employee, right? That's the pitch. And so that's how that math works out. Depending on which of these pathways we access the credit, we get different lengths of time. And so if we access it through this path, we generally get the whole quarter in which we have the gross receipts reduction and at least the next quarter. If we fit in through this pathway, we get the credit on wages paid during the period of the government order. So that's a difference that we'll come back to here in a few minutes. All right, let's jump on ahead. And here we're talking about employers, people who pay wages. It's almost all employers that could qualify, and there's no absolute business size max, but we'll come back to business size in just a moment. State and local governments are carved out, and their instrumentalities, so some of the quasi-governmental agencies also get sucked into that prohibition. All right, so broad definition of employers. We have, in your materials, you're going to see a couple of little slides next. Those were the big full-page handouts in the back, front and back. The thing to orient yourself is our font is probably too small, and that's my fault. The first side says 2020 in the top left corner. Get out your readers. And the back side says 2021. Okay? So the chart looks almost the same, but we're going to see some of these key thresholds are different on what level of gross receipts reduction would be required to get it under the first prong, and then also what our definition of large is. And so we will go ahead and talk about this large definition. All right, so one of the things about ERC that's a little bit confusing is that big companies and small companies can get it, but if you are a large company under their definitions, you only get it on people you paid while they were idle. And most of our clients didn't have a long period of time where they were paying a lot of people not to work. There were some businesses that had some of that, but at scale, it's not that big of a population. It's not that big of a dollar amount of people who were a large employer and paid people not to work. Okay? So, because we only get to take the credit, the $26,000 credit on people we paid not to work if we're large, we want to know what's the definition of large. And it changes between the 2020 credit and the 2021 credit. For 2020, large was if you had more than 100 full-time employees. In what year? 2019. So for a lot of our measurements, we're going back to the full year before COVID, 2019. So our 2019 employee count matters, and we're looking back to that period of time to determine if we're large. We have a different definition of large in 2020, the 100 employee threshold. In 2021, that kicks up to a 500 employee threshold. So we had a lot of clients who were large businesses in 2020, and they suddenly became small businesses in 2021 for purposes. Right.
And that's all full time. That's all full time.
Full-time employees based on a 30-hour work week. And Kurt asked a good question ahead of the presentation. We have a slide here that illustrates the math on a sample, and we're not going to spend time on it here together, but we're going through and saying employee D and employee E were full-time for this month. So that's 2 out of how many is it? 8, 7. So 2 here, 2 here, 2 here. These other guys were all part-time, so they don't count. And then we come through and we see them for the 12 months. We added up all the full-time employees. There were 32 months, 32-month employees, and then divide by 12, and so that says that our full-time employee count was 2.67. Clearly small in this example. I chose not to give you a 130 employee organization on this slide. So again, you can take that with you and make sure that you apply that in your organization, especially for those who say we issued 150 W-2s. That doesn't mean you're large. We got to run this back.
Yes. Use the same chart for 2020.
Yes, the math's the same. The threshold just changes from 100 to 500.
Because you're always using 2019.
Because you're always using 2019 numbers.
To determine the numbers. So you've got to go back to 2019 as the baseline for the calculation of full-time employees.
All right. So hopefully we kind of have a baseline understanding of how this credit's working. Super complicated because they kept tinkering with it over time. And I'm going to kick it over to Jeremy to help us walk through our first and favorite pathway into the ERC.
Yeah, I marked through short straw on this because this one is actually more to be black and white quantitative test, and we'll see. There's still ways to plan with this, but a lot of the confusion, a lot of the gray area relates to the second gate to get through. So gross receipts, we're not going to go through all of these. This is also something that was handed out in previous presentations. But for the most part, it's any income from any source whatsoever, whether that's sale of goods or provision of services, investment income, rents. It doesn't matter whether the income is all business income, whether it's passive or non-passive. Any income from all sources, generally speaking, is going to be gross receipts for purposes of this test. Now, one of the things to keep in mind is we mentioned this is a for-profit entity. We'll take a look at this in a not-for-profit space, because there's one key difference associated with that that may make a difference, particularly for our not-for-profit clients. And so that really gets to this idea of net gain. So if we look, income from all sources, including the net gain. So if you sell a piece of equipment in your business or you sell an investment, it is the net capital gain that's included for gross receipt purposes. Now, if we have a net capital loss, what do? We don't know. We still don't know. 2.5 years in, and they're never going to tell us. Is it zero? Is it negative? I don't know. And I'm not sure we're ever going to get that answer. So the answer is yes. It's either one of those, depending on which helps you. But so net capital gains are what are included for for-profit entities. If we look at not-for-profit entities, same concept. Income from all sources whatsoever. Grant income, contributions, any investment income. The difference, however, in the not-for-profit world is that it includes the gross income on sale of assets, not net. So if you have a piece of equipment, more likely if you have an endowment or an investment account and you sell securities out of that, what we're looking at for gross receipt purposes for a not-for-profit entity is that gross amount. So a not-for-profit entity could get into or maybe kick itself out of this credit, or it could, let's say, get into this credit merely by having a larger amount of trading activity in 2019 within that than what it did in 20 or 21. And that's something that's probably not always apparent until you do the math associated with this. So that's the main thing to keep in mind. And really all of that is related to the fact that in both instances, whether it's for-profit or not-for-profit, these definitions are driven by the income tax rules associated with your business. Whatever reporting methodology you use for federal income tax purposes, that drives how you calculate gross receipts for purposes of ERC. So if I'm on a cash basis for income tax purposes, but I keep my books on an accrual basis, it doesn't matter whether I can get into the credit under an accrual basis. That doesn't get me there. I have to use the same methodology that I use for income tax purposes, which in this example would be cash. Having said all of that, even though we don't get to pick and choose which methodologies we use, we have to stick to whatever we use for tax purposes. That's not to say we have absolutely no flexibility. And I think in addition to that, a lot of businesses, due to a little kind of quirk in this, it's going to keep coming back up when both Mark and I are speaking about these different gates, so to speak. A lot of people self-select themselves out of this before they even really look at it, okay? And that leads us then to this first myth that we're busting associated with this, and that's that the gross receipts reduction test under the ERC doesn't in any way have to be, it doesn't have to be in any way related to COVID. You just have to mechanically show a reduction in gross receipts at the appropriate level between whatever quarter you're looking at in this equivalent quarter in 2019. So, what we recommend in all instances is no matter what, whether you think you're killing it in 2020, you had a good year in 2020, you had a good year in 2021, maybe you had a down quarter. So we want to run the math for every one of those quarters before we do anything else, because if you get in under the gross receipts test, you get in for that entire quarter no matter what restrictions you are under, and generally speaking, in a lot of instances, qualification for one quarter will get you a second quarter based upon the mechanics of this. In addition, if you're a not-for-profit or if you have not-for-profit customers or clients that you're working with, we have to look at the gross receipts from the sales of assets. So same thing, if you've got someone that has an endowment, we have to look at the trading activity within that. You may not think you qualify until you do the math on those, and in some instances that may be enough to get you there. In addition, even though we're stuck with the federal method of accounting or federal method of determination of gross receipts, that's not to say in all instances we don't have the ability to adjust that retroactively. We've done this for clients. So for example, let's say your business typically reports on an accrual basis for income tax purposes, but you meet the requirements of being able to report on a cash basis. We have seen situations where you run the math on an accrual basis and it doesn't quite get you there. Flip the switch and say, okay, what if I were on cash both in 19 and in 2020 or 2021? And lo and behold, based upon the nature of when you receive the cash, you actually qualify for a quarter. Now we've got to do due diligence and make sure it otherwise makes sense to make that election and put you into that new basis of accounting. But if we can, we've done that for some clients and produced some pretty significant results associated with that just by flipping that method of accounting. So we have to stick with it. But just because we're in that method now doesn't mean we don't have the ability in some instances to change the methodology. So we'll want to look at that as well. One thing to keep in mind associated with this as well is that PPP loan proceeds are not deemed to be gross receipts for purposes of this. So if your business received forgiven PPP loans in 2020 or 2021, those do not count against you for purposes of this calculation. I don't think we've received guidance, and I may be wrong, on provider relief and other types of, I don't know that those have the same specific exemption that PPP does, but that will typically be one of the biggest items. And frankly, in some instances, it's also going to be, although it doesn't hurt us from the calculation, it does tend to impact our 2020 calculations of the credit because you can't use the same wages that you use for PPP forgiveness to also qualify for the ERC. So for a lot of businesses, they had a lot of payroll that was paid for in 2020 utilizing PPP. All right, so we said check it for all quarters. What do we mean by all quarters? Well, for 2020 and 2021, with one exception, you take the quarter that you want to look at in that particular year, and you compare it to the equivalent quarter in 2019, because again, that's pre-COVID times, that's our baseline. There is, however, one exception to that, and that's in Q1 of 2021. You can also qualify in Q1 of 2021 if you meet the more than 20% reduction in Q4 of 2020. Because for 2021, and this gets where the rules change between these 2 years, you can qualify for a quarter in 2021 based upon a reduction in the immediately preceding quarter. So that brings Q4 of 2020 into play to qualify you for Q1 of 21. That's also the reason why if you typically qualify for one quarter, that qualifies you for two. Because let's say we had a more than 20% reduction in Q1 of 21, and we didn't in Q2 of 22, or Q2 of 21, sorry, we can utilize the reduction in the immediately preceding quarter to qualify. We don't have to be consistent. So we can use Q1 of 21's reduction to qualify for both Q1 of 21 and Q2 of 21. Simple, right? Super.
One quarter will get you 6 months. Sounds
Yeah,
good.
right. All right, multiple businesses. We will not spend a ton of time on this, but this is something we have to look out for. Generally speaking, if you have a controlled group of entities or related brother sister entities with common majority ownership, we're going to have to look at whether they qualify as one entity. So in the example here, we have ABC and DPF companies. ABC qualifies under the more than 20% reduction. Great, we've got the credit. Well, maybe not, because in most instances, we're going to have to look at DEF, bring their activity into the same calculation and make that determination on a controlled group basis. Those are complicated rules. It's just something that if you have related entities, we definitely need to look at that. Maybe that helps you get into the credit. Maybe it kicks you out of the credit, but we definitely have to look at that.
We've seen both.
Does it
Yeah.
depend on whether or not you have employees in all of those companies?
It does not. So you could have, we could have a business owner that had, operating entity of one, maybe a rental real estate business in the other, and only have employees in one. You'd have to look at both of those together to determine whether you aggregate it. But same thing, if it qualifies you, then all of the wages for all of the businesses would qualify. But it doesn't. You don't. Just because you don't have employees in one of the related businesses doesn't mean you get to exclude them from the calculation.
Question. Yeah.
All right, so that's as black and white as it gets.
So
And with that, then yeah.
So the crazy thing is, a company could have increased sales, Jeremy, right, and increased profitability in each of 2020 and 21 for the calendar year,
Yes.
and still qualify for the ERC under the gross receipts.
Yes. You had bad order.
Bad quarter gets us there. We've seen nonprofits where the revenue comes in a lumpy way, and they got two big donations in this quarter, quarter two this year, and they came in quarters 2 and 3 in 2019, and that's enough to tip the scales for them. So it can end up really quirky things, especially for cash receipts-based businesses.
Yeah, and I didn't use this example today. I guess I should have, but we'll mention it now before we move on. For example, there's a law firm that contacted us wanting some assistance with this. They really, 2020 and 2021 was pretty normal for any given year, but they had a large settlement in one quarter of 2019. Mechanically, they get the credit. And so and that just gets back to that idea of whether it's related to COVID or not, it doesn't matter. That test is what it is. It has no cares in the world about why you had a reduction in gross receipts. We can argue whether that should have been a policy, or not, but that is what it is. And so they qualified for the better part of, 2020 and probably even 2021 based upon just a higher than average 2019.
Yeah. So we go from the crystal clarity, right, of our gross receipts-based test to the utter nonsense and murkiness of the government borders test. So, we intentionally said we're going to test gross receipts first because it's clearer and it provides the best benefit. For any quarter where we didn't qualify under gross receipts, the next part of our analysis is to look at the government borders test for that quarter and see if that gives us access to credit. And so we're gonna spend a lot of time for the rest of our presentation really wading through some of the nastiness that is the government borders test. All right. So there's some basic requirements here that are on your slide deck. I break it down into about 5 requirements. We need to have an order. An order, think of it like if you're ordering your kids around, what does that sound like? Don't do that. I need you to do this. It's not things like I would like you to clean up your room. You will clean up your room. So there's not a lot of discretion for the recipient of that order about what it is that they're supposed to do. It needs to be from a government authority. So having the CEO of your organization say, hey, we're going to all do social distancing, that's not a government order, that's an internal order. Doesn't count. We have some examples in here of press box type comments that hey, you guys should really think about limiting the number of people that are coming into your door. That's not it. City of Columbia saying you got to push pizzas out the window, or you can only have 10 of your 50 tables open. That's what we're looking for. There needs to be a limitation on commerce, travel, or group meetings. Most of the restrictions that we're talking about or thinking about here on the government orders, it does have to be related to COVID-19. And we have an example here. If somebody has a dirty kitchen and the government comes in and says you need to close your business because you've had too many health code violations, it meets every single one of these requirements, except it's not due to COVID, right? So we're looking for things that say, whereas the COVID pandemic is taking the world by storm, we're going to enact these restrictions. Okay, so, and then it needs to result in either a full suspension of your business or a partial suspension of your business. So if you stopped reading at full suspension, you'd say, let's take this and throw it in the garbage can, because most governments didn't shut down businesses in whole at all, and most governments that didn't do it for very long. But this partial suspension is where we're going to be spending a lot of our time. All right, that's the basic requirements of government order. Again, just to hammer this point home. So a business that was under a government order could have had the best year ever and the best quarter ever all the way through COVID, and they still get access to this credit if the government placed a meaningful enough restriction on their business that, in theory, would have prevented them from achieving their full potential. So even if we have an up year, we can get access to or up orders, string of up orders, we can get access to ERC under the government order test. That's why we say the analysis is under both. Start with gross receipts. If you hit brick walls for any quarters under gross receipts, then we come down to the government orders test. All right. We're going to try not to philosophize or too much, but this is weird, right? Like two businesses that did the exact same thing during COVID could have a different credit result depending on whether the CEO ordered it versus the mayor in the city in which they conduct business, right? So two businesses that were otherwise identical may have said, we're not going to have any in-seat dining. We're going to go exclusively to drive-through. And if one business did it because the government told you thou shalt close your indoor seating, they're into the credit for that period of time. If the CEO just said, hey, I think that's the right thing to do, they don't get the credit. Okay? So that's the primary point of this slide, is that state and local policies are driving the federal tax consequences. Now, one of the challenges we're encountering now, as we're helping people later in the ERC season get through it, is for political reasons, several communities are starting to take down their COVID orders off of their website or publicly available information. So it's getting harder and harder and harder to figure out or to pull the documentation now to support it, especially for people who are in where their businesses are in other counties that we might not have already collected experiences now. All right. So here, full and partial. So full, we're not going to spend very much time on. It's generally pretty easy because the lights aren't on and no employees are coming into work and no customers are coming into the place of business. It's pretty rare. But partial suspensions are where the activity is. And so the test that the IRS has given us about what they think this means is that if under the facts and circumstances, more than a nominal portion of your business operations are suspended by a government order, then you're in. And we'll go through some more concrete examples in here in just a minute. But our next 3 slides or so are going to be focused on this portion, partial suspension, which is where the action is under the government orders test. All right, again, we have to have an enforceable mandate. The mandate has to require some action or inaction. Precatory or recommended actions is not enough. And we're looking for things that had a more than nominal impact on business operations. So business operations could mean revenue, but it could also mean other things beyond revenue. All right, so we have several examples that are baked in here through the slides. We'll highlight a few of them here together. The others will be there for you to read at home as well. We're going to have some examples about supply chain. Jeremy will touch on that in a little bit, about demand side, what's the impact. I ran through the example of the CEO just says, hey, I think this is the right thing to do. The government didn't order it, but I think this is the right thing to do. That doesn't get us there. Telework is problematic. Williams-Keepers. We took a lot of our people from working on computers here to working on computers in their home office, and there wasn't much lag in between. And so the government says, your ability to telework really caused you not to have a shutdown, even if the federal government said there's a capacity limit on your business that forced that change. There's some arbitrary line drawing in here because a fast food restaurant that goes from passing a cheeseburger across the counter to passing the cheeseburger out the drive-through window only, IRS says that clearly qualifies as a partial shutdown order. So we had some restaurant clients that were operating multiple different locations, and we'll talk about multiple locations here in a second, but one of those locations said cheeseburger has to go out the drive-through window, can't go across the counter. As long as that rule is in place, that's a partial shutdown. Okay. And that's one of the ones that is less unclear than a lot of these things, because that's an example that the IRS has said about.
All right, matter if you push more through the drive-through than what you would have done across the counter.
Correct. Yes, absolutely. Telework we talked about. So restaurant, indoor dining being closed, definitely yes. Spacing limitations with a more than nominal impact. So that's my example. I used to have 50 tables, and because of social distancing requirements, I had to reduce it to 20 tables. That clearly qualifies. If I had to take out 1 table out of 50, maybe it does, maybe it doesn't. And so you can end up with these weird differences where Salon A and Salon B are right next to each other, but Salon A had its stations 5 feet apart to start with, Salon B had its stations 8 feet apart to start with, and you get different results on how the code orders apply, depending on whether you feel there's Salon A or Salon B. So there's some randomness, some unfair line drawing that comes in through this. Medical, we've seen this. A lot of people say, I was in medical, I was in construction, I was an essential business, so therefore I didn't get a partial shutdown. Well, in the medical space, there were situations where hospitals or groups were told, yeah, but you can't do elective procedures. We need to reserve the capacity for COVID patients and other required procedures. That's a partial shutdown order. Grocery store, we have a neat example where they say, wait, the lights are on, you can go to every aisle, but you can't go to the salad bar. Yeah, it's too small. We're not going to consider that a government shutdown. So we have some clear examples over here about things that are really nominal, some clear examples over here of things that are really not nominal, really significant to benefits, and then a whole bunch of gray in between where people are cobbling together the best arguments they can that, hey, I found a government order and it affected my business in this way and it changed their operations. And so a lot of them that we're seeing are capacity type limitations where the government came in and said, you used to be able to have 100 people in your building, now you can only have 20 people in your building. So what's the impact on your business if it's a more than nominal change in your business operations? Drawing analogies to some of those other examples of fast food restaurants and things, then you can perhaps get to that conclusion that we had a partial shutdown. All right, multiple locations are fun. So this is one of the things in the IRS guidance that I think everyone who read it was shocked about. Usually when the IRS comes out with guidance, it's a more conservative, anti-taxpayer interpretation of what the rules could be. And this is an example where they came out with some rules that were definitely not anti-taxpayer. So for businesses so the crazy thing about this is, let's say that I own a local restaurant in Cole County and we had one location. And Cole County said, Mark, after a certain date, you can let however many people want to come to your restaurant into your restaurant and serve them, and we're not going to restrict it at all. So in that example, once all restrictions were lifted, then I was under no partial shutdown order, and if my sales were high enough, I'm not going to get it. But now I'm an entrepreneur, and instead of owning one location in Cole County, I'd have owned one location in Cole County, one in St. Louis, and one in Kansas City. And so now I get access to St. Louis, their rules. I get access to Kansas City's rules. And I think most of us who are thinking about this situation said, well, it would make sense that if I'm under the order in St. Louis or Kansas City, I would get the credit on my employees that were in Kansas City and St. Louis. But the IRS did us a solid and said, no, we're not going to look at where you had your employees. If you have a location in Kansas City and Kansas City says you can't let people into your restaurant, you can do all the takeout you want, but they can't come and sit down at a table, then we're going to give you the credit in Kansas City. We're going to give you the credit in St. Louis. We're going to give you the credit in Jeff City. Okay? So that creates this huge and crazy opportunity for ERC, especially for businesses with multiple business lines, aggregated groups with multiple businesses, single line businesses with multiple locations, where the most restrictive government that they operate under becomes the one that matters for determining the duration of our partial shutdown for ERC purposes. I'll ask if that makes sense. From a policy perspective, I'm not sure it makes sense, but
it's one business, not one owner that owns multiple businesses. Multiple locations with one single business entity. If Bob owns a car dealership and a restaurant and they're two different jurisdictions.
Yeah.
It's the same owner. That is
Slightly different.
That's slightly different analysis, but you still get to a broad result in some situations.
Yeah. It's possible. It's not quite as easy.
It's not quite as easy as one owner, same business across. Okay. So yeah, that's an important. So one business with multiple locations is an easier and broad rule that says we're going to look to the most restricted jurisdiction. A shutdown anywhere is a shutdown everywhere. Okay. All right, Jeremy, will you bust us another myth?
Yeah, and I think before we move on from that, just on the other side of that equation, so multiple locations, same trade or business, shut down in one location, shut down in all locations. If you have a single owner with multiple businesses, so in your example, they had two different businesses, where you would possibly get to that is you would aggregate them, and if the one that had the restriction was a large enough percentage of the whole, and at this point the best we have is at 10%, safe harbor, that's how you would still get to that same outcome, where it would bring the entirety of it under a government order for purposes of credit. Now, if the restaurant was just a tiny piece of what they did, it may not be enough to get you into the credit. So it is slightly more difficult if there are two separate trades or businesses. So just to close the loop on that.
So I mean, we've had examples where people own construction companies and other businesses, and the construction company wasn't subject to a shutdown, but the spouse owned a business interest in something else, and then we're looking at, all right, is that something else big enough relative to their aggregated gross receipts to justify? But crazy thing is if the answer is yes,
Yeah.
then we're taking ERC on construction wages that were busy and fully working and not subject to a partial shutdown.
That's the right reaction.
You probably can't see that on the camera, but that was a head shake. Okay, so, the cool thing about the guidance is we have some really good specific examples. The problem is, as Mark talked through it, mentioned this, the real world doesn't really tend to fit in most instances neatly within the examples we have. So there's a lot of empty space or a lot of gray area that we've got to sort of fill in the blanks or try to figure out if it's closer to black or closer to white. Now, through this process, so we are seeing some arguments that we do have some concerns about, okay, where people are taking what we feel to be kind of forgetting the gray and moving it entirely in one direction where it shouldn't go. And so that gets to this next item. So, in our opinion, and this isn't just our opinion, but in the opinion of others within our industry, CDC recommendations alone or broad-based guidance from OSHA do not constitute a government mandate for purposes of ERC. Okay? There are some that are making that argument very aggressively that would say that these broad national entities and the recommendations and the guidelines that they have provide blanket government orders for purposes of getting in under this credit. So if you take that to its logical conclusion, they would argue, I believe, if pressed, that businesses would still be under government order today, and if the ERC were to magically come back for this quarter, which it won't, but if it did, you would still be subject to a government order. That is definitely not within the spirit of the guidance we have, and I think we would argue isn't anywhere near the letter of the guidance we have either. So if you take these one-on-one, CDC recommendations are just that, recommendations. They are not thou shalt or thou shalt not. They are, this is what we recommend you do. Now, having said that, a lot of times if you look at the state and local guidance, it's difficult to find, but if you pull up the Cole County guidance, I'm sure you pull up the Boone County guidance, you pull up Governor Parson and the Department of Health and Senior Services guidance. In most instances, they are probably looking to CDC guidelines. But the difference in that situation is there is some state or local government entity that is effectively codifying those recommendations and saying, we are going to follow them and we are demanding that you do this or that you do not do this. Okay? That's the difference. But in jurisdictions where you don't have that, those CDC recommendations are just recommendations, which is not to the level of an enforceable mandate. Where OSHA comes into play is one of the things that OSHA agents can look at in determining whether a business is in compliance or not is the CDC recommendations. Okay? And OSHA also has this general duty clause, which basically says anyone that has employees is required to provide a workplace that's free from high likelihood of significant injury or death, right? So what they're saying is because an agent may look at the CDC guidance, but there is nowhere in that where they are required to follow CDC guidance, but because they can, and every business is under OSHA, therefore, every business is subject to a government mandate from March of 2020 until as we sit here today. It just doesn't work. And I think there are a couple of ways to do that. One is looking at the OSHA, memos and guidance themselves. They leave open the possibility that a business can be in compliance even if they had restrictions internally that were less stringent than the CDC recommendations, which tends to blow a hole in that argument. In addition to that, if you look at the notice that the IRS has put out, there is guidance, and there's nothing that specifically looks at this situation, but there is an example, and I think it's a multiple business location example. And it's trying to make a different point, but in that example, you have a business that's in multiple jurisdictions. In one of them, it is subject to an honest-to-goodness state or local mandate, where the governor or the mayor, or whoever it is, mandated compliance with CDC recommendations that limited their business. This business is also operating in localities where there are no such state or local restrictions, but they on their own voluntarily decided to follow CDC guidance. In the example, the applicability or their eligibility for the credit, they get into the credit not because of those jurisdictions where they were doing what was recommended, but because of the one jurisdiction where they were subject to the state or local mandate. Those other jurisdictions are entirely irrelevant for how that determination is made in the example. They're just piggybacking, yeah. And even if they weren't doing anything different in those jurisdictions, it doesn't matter. It's not a good fact or a bad fact. It's just a fact that's irrelevant to whether they qualify or not in that example. And so that's the position that we would take associated with this. But there are a lot of individuals, again, particularly within our market, that are relying on this guidance as the beginning and end of their suggesting that a business can get into it. And that's what's breeding a lot of those, those commercials, the $27,000 per employee or $26,000 per employee, tax benefit. Because there's no other work that's done at that point. They say you qualify for all quarters, they'll do a marginal job of trying to tie that to, okay, you were impacted by government, you were impacted by COVID, great, everyone can say they were impacted by COVID, let's move on. And I think there is a really significant risk of audit, or the bad outcome on audit utilizing one of those provisions. And so I wouldn't do it, wouldn't recommend anyone do it. Chris?
So under that OSHA thought process, would every business in America qualify for the RC?
Anyone that had employees.
Yeah, the less people qualify for DRC, remember, people pay wages to employees.
Right, so yes, so they would. And it would be, they would all qualify. There was a point I was going to make. So all businesses would qualify for the credit. Right. And so I think that's what you have to take that to its logical conclusion is yes, all businesses would qualify for a credit for the entire period of time. The only thing you would have to prove my mind was caught up with where I was with my mouth, which is usually a problem. You still have to show them more than nominal, right? So maybe that's where maybe they wouldn't get it now. But anyone that's doing anything associated with COVID, what we're seeing in these studies are, you tell us, you being the client who's paying for this service, you tell us how you were impacted. We will not measure or do any type of analysis to determine whether that really did have a significant impact on your business, unless you qualify for the credit. Every business will qualify for the credit for all quarters, unless they self-report and say, COVID really didn't impact us. We didn't have to do any extra cleaning. We didn't really have additional absenteeism. We did try to observe social distancing. That would be one situation. But yeah, as long as you met that requirement, you would qualify. And it's not, if they being Congress wanted to write a law that allowed all businesses to qualify for this credit, they would have written a law that allowed all businesses to qualify for the credit. That's basically what PPP was. We've seen it, they've done it. This isn't PPP. Even though you do hear that a lot. Can you tell me about what this new PPP3 is? I've been hearing a lot about it. Now, having said all of that, depending on the industry, you may actually be subject to some OSHA regulations, but there's nothing that blanket covers everybody. But again, healthcare businesses, there are some. There were the OSHA mandates that specifically mandated compliance with certain CDC guidelines. So again, food service, healthcare, if you're in those industries, we definitely want to take a look. There may be orders associated with that. Again, we've got to look at the period of time, though, because that's the other piece with the government orders test. You only get the credit for the period of time you're under the order. But there are some specific industries where, yes, we want to take a look at that and see if this holds water. But it's not going to be the blanket, get rich quick qualification that it may be being sold as in some instances. All right. Another thing that we're seeing, and this is really just something that's kind of a misconception with this. Generally speaking, government orders that impact clients' or customers' ability to access you, strangely enough, do not get you into the credit. Okay? Generally, that is not going to make you eligible. If demand goes down because of restrictions on your customers, that's generally not a good fact. So although supply side disruptions can get you there, and we're going to talk about that next, demand side disruptions generally do not. And there's a specific example of this in the IRS guidance. It seems odd, But the rationale behind that is if you had a significant enough impact on your demand, well, guess what? We've given you the gross receipts test. You should qualify under the gross receipts test, and if you don't, maybe you weren't impacted as much as what you thought you were. And again, we can quibble now with the more than 50% or more than 20%. Absolutely, but that's the rationale. Again, no judgment or no editorializing with it. That's the argument that the IRS made in the notice guidance. The second bullet point, this is not from any guidance, this is from Jeremy's head, which as we've already discussed, may be a little bit dangerous. This is how I think about it. If I was under audit with this, I'm not sure if I don't know if this would hold or not, but generally speaking, here's how I think of this. If customers had had access to my business as they always had, and I had a normal level of demand, could I have delivered the product or service in generally the same way that I did before COVID or before these restrictions? Or was there a more than nominal disruption in my ability to serve my customers had they actually come to me? Okay, so had I had access to my customers, can I generally, provide the same product or service in the way I had before? If the answer is yes, I can provide it in the same way as I did before, that's really not a government mandate that's probably going to get you there. That's more of a demand side problem, not the supply side problem. Okay, clear as mud. Supply side. Supply chain disruptions will get you there, but I would urge a bit of caution with this. This is going to apply in very limited circumstances, and it's probably going to be one of the hardest things to substantiate when it comes to this. Okay? So there is definitely an example in the notice guidance that says you had a supplier that was shut down due to COVID, you could not get access to supplies you needed, therefore their government restriction flows down to you, assuming it had a more than nominal impact on your business, and therefore your business is under a government mandate. The one key to that example, though, is not only did your supplier have a shutdown that was associated with COVID and your COVID restrictions from a government entity, but you were also unable to access an alternate supplier. They kind of threw that in there as a little bit of a gem, and I think, or maybe as a little bit of a landmine associated with it. Now, could you get there without that? Maybe, but that's the example given. So one, did you easily have access to other suppliers? And if you think it's hard to determine whether your trade or business location was subject to a government mandate, now we've got to go to a supplier and get comfortable with the fact that they, in whatever location they were in, that supply chain problem was actually not just some other market-based supply chain problem, but really is related to a government mandate in that jurisdiction. You can get there, absolutely get there, but it's going to be difficult. And I would just urge, if that's the only thing we have to hang our hat on, there's going to be some risk associated with that. This one typically works well in addition to some other government mandate that messes up your business operations. So it'll work, but it's not going to be the be-all, end-all that gets you into this because everyone has supply chain problems. All right, so that is the government orders test, some myths. Before we move on to the last couple of items in the last, say, 5 to 10 minutes, any questions on that before we move on? Right. That we'll talk timelines.
All right. I'm going to go through these just real quickly, but when we think back on COVID, I think everyone's sense of time gets distorted in weird ways, where in some ways it feels like it was 16 years long, in other ways it feels like it was like an instant. I don't know. 16 years long, and the government had to shut down for the entire time. So I think the important takeaways on this is from a statewide perspective, there were only statewide limitations in Missouri for March 23rd through June 16th of 2020. So for fewer than 3 months, were there any statewide government restrictions, broadly speaking, across broad industries? Specific industries, you're subject to health, human service, you're subject to health regulations or other regulations. That's not what we're talking about. We're talking about broad societal, hey, everyone, you're subject to these limitations. Relatively speaking, short period of time. It also happens to coincide with the time where PPP dollars were rolling out, and we said PPP funded payroll can't be used to support ERC. So even if your business can show a partial shutdown during that's relying just on this very statewide period, you're going to have a benefit that gets squeezed by down to a percentage of the wages that were paid that you actually funded that weren't funded. All right, so that's the state. Cole County, we have a narrower period of time, and then they just said, okay, we're going to follow and do what the state did. So that's why we're focusing on the state. We have a couple people I know that are from Boone County, and so Boone County, it extended for more than a year. So we lifted all orders in Boone County, City of Columbia, May of 2021. So again, you get 2 restaurants and 2 communities, they get different ERC results just because the governments that apply to them, we're doing different things. All right. We're going to talk about IRS timeline first, Jeremy.
This will be quick, unlike the refunds themselves. If you have something you haven't watched on Netflix and you want to binge, just find it and wait your sweet time. Unfortunately, the IRS is taking their time on these. It is taking at least 6 months to process amended payroll tax returns claiming the credit. At least 6 months. Now, there's a correlation, maybe not causation, related to this, but it does tend to appear that the larger refund claims are taking longer periods of time than that 6 months. Okay? And it's one of those, it's a variety of factors. I mean, one of them is that these are all hard copy returns. They're sitting in a stack of hard copy returns waiting for a human being to pick them up and work them through them in order. The other thing is because of some of the other things we're seeing in our market, not to bash people with this, but they're flooding now for all of these businesses that are doing this for every quarter, whether they should be or not. Those are now flooding the IRS offices, and they've got to work through those with everyone else. So the supply of these returns is high. The supply of workers to work them is low, but hey, the IRS has got some funding now, so they're going to take care of that soon. We can all be excited about that. And so it's just going to take a while. So please be patient. I would say for the staff that are sitting in this room and the staff sitting out there, I will say that we do know that no matter how many times we call the IRS, it makes no difference whatsoever in how quickly you get the refund. So I'll just say that now. We can keep checking, but they're telling us now don't even bother before 20 weeks, and honestly 6 months is at least a period of time that it's going to take. Here's why this causes a bit of an issue, though. This is taxable income in the year that relates to credit, not when you get the refund. So if you're claiming a credit for 2020, even if you don't get that refund until 2023, which we may have happen in some instances, guess when that's taxable income? 2020. The IRS is super clear about that, even though they're not clear about much else. So we've got a situation where this credit can be such a big piece when compared to your net income for the year, that you may have a significant tax event associated with this, and you still don't have the money. And that is a legitimate concern related to this. And again, there's not a whole lot that we can do about it, either push returns off or just pay the penalty and interest whenever we file the amended claims. And in a lot of instances, they are paying, well, I say in all instances, they will be paying interest on their ERC refunds back from the original due date of the payroll tax returns. So there will be offset associated with that. In addition, the IRS has said that they are, it has reminded taxpayers very helpfully that there are ways to get relief from penalties for a reasonable cause, even in these situations. And there's always first-time abatements.
So, I have a question. Have any of them came back with an adjusted amount?
Of the credit, they have not that I've seen. If it is, it's due to error, right? Because that's the kicker on all of this. We had a question yesterday about, are they doing the same type of analysis and review that they did for PPP? And the answer is no, because there is no study that goes along with this. There is no self-reporting. The only thing the IRS gets at this point is an amended payroll tax return that says how much credit are you claiming.
The only situation I've seen where adjustments were some clients prepared their own amended payroll tax returns, and they used the 50% credit percentage from 2020 and used that again in 2021, or the 70% on 2020 when they weren't supposed to. the IRS says, yeah, 70%, so here's your adjusted credit amount. So,
What if a client has used the same wages for, that's not ever be picked up on?
Yeah, I mean, even then, I don't know, but they should be looking at that. I mean, that's one of the big restrictions on this. That's one of the difficult things that we do with these calculations. I mean, most of the businesses, particularly in 2020, had PPP as well. So then it becomes an analysis of, okay, what did you file in the PPP forgiveness app, and you're stuck with that. And now we can work around that. So if you had a PPP application and we used a 16-week window and used $2 million in wages, even though we only needed like 500,000, we're being creative within that 16-week period to try to move that 500,000 in wages to a period where we don't want ERC, but it has to be within the 16 weeks. If a business used 8 weeks and that happens to coincide with the ERC period and they could have gotten it in 16 weeks, I think you're out of luck. I think they filed a PPP forgiveness application with 8 weeks and we're stuck with that. So we are looking at it and working around it. That should be something that they look at when they audit. That's the only mechanism now for that to be audited.
and that's the unfortunate thing is when people were filling out those PPP applications, they didn't know they were potentially ERC eligible because at the time they were completing them, they weren't ERC eligible. Right. It wasn't until December around Christmas time when they changed the law and made them retroactively eligible that issue clarified. And so we are seeing a few people get whipsawed by that. We are at our time, and I know there are people who have obligations outside of here. So can we just take a quick breath and let anyone who needs to excuse themselves exit, and then we'll open it up to questions. Does that sound okay?